Welcome, everybody, to Coffee with Christie. Today, I have a special guest, Mike Rolston with U.S. Lending. He happens to be one of my top lenders that I've been using in the business probably like the last 5 years now, right?
Yes, that's
5,
true.
6 years
That's
about.
correct.
Yeah, and so I really wanted to bring him on, talk about today's market and the whole lending process, also dissect some of the vocabulary that you hear from agents or from your lenders and kind of better understand the home buying process. So welcome. Thank you so
for
much.
having me.
Thank you for coming on Coffee with Christie. I'm so excited to have you here. This is actually our second interview first one was done before the podcast and then now this one. So thank you for being here.
You're welcome.
So to get started, first of all, how did you even get into lending? Well, you've been in lending a long time, correct?
Correct.
How many years?
This will be my 21st year.
21st year. Wow, that's amazing. So what led you to the lending field? Were you always in banking or?
No, went to school at Cal State San Bernardino, got a degree in finance. Always wanted to do either car lending, was in the car industry for a little bit.
Oh, okay.
Got an opportunity with my uncle who worked at Countrywide. Dated myself back in the day.
Yeah.
Opened the door and the rest is history.
So were you part of the whole situation with Countrywide and then Bank of America ends up
Correct.
taking over? So were you working at Countrywide at the time?
Yes, and we found out 6 a.m., I think that day on a Friday, that we were selling to Bank of America.
Wow.
And everything would change from there.
So did you get to keep your job working when it transitioned to Bank of America, or were a lot of people let go?
At least the sales staff, we remained the same. We just transitioned into Bank of America home loans versus Countrywide home loans.
Okay.
So, and I think a lot of the offices stayed open. They kind of just basically changed the name.
Just change the name. Same people change the name, change the policies, correct?
Policies, loan programs, a little different. We added a few more because B of A had some back then that Countrywide did not. So.
Yeah.
You know, we were trying to be optimistic about it because it was right after the crash.
Right.
I think this was 2009 when all this happened.
Wow.
So there was so many things going on, shutdowns from other lenders, and, you know, we just transitioned and tried to make the best of it.
Before I ask you more questions about that, is there a difference between car dealership and buying homes? I know often real estate agents are in a negative sense referred to as car salespeople, which I don't think there's bad car salespeople out there either. I think it's an industry that we all need because I buy a car, you buy a car, everybody does, but just like with agents, I think is there a difference in the car dealership than there is in the home industry?
Well, I did more of the finance side. I was doing contracts. So in the business office back then, I think the misconception is maybe the used car salesman, which they got a bad rap. I mean, there's good and bad in every industry.
Exactly. And so, you're right. In every industry, there's
some are more aggressive than others. And,
yes.
I guess when it's used cars, sometimes you worry about, are you buying a lemon, which a house, I think there's more procedures to avoid the lemons versus a car. So,
yeah, that's true.
But it's an interesting industry. I know they're kind of connected.
Yeah.
As far as when we're busy, it seems like the car industry is busy as well.
I had a friend who worked in the finance department also in the dealership industry, and her responsibility was lending to car dealers, huge car dealers, and her company lent them the money to go out and buy the fleets to be able to sell. And I remember when the market crashed, her having to sit there and because it was a hard time for everybody, and not just one person. Every single industry was hit when the market crashed. Definitely.
Yeah, our industry affects multiple industries. Even now, we're seeing a lot of people affected.
Right.
Especially the car industry.
Definitely. Oh my gosh, really? Definitely during COVID, you saw a huge hit, and just because of being able to get supply and demand.
Yeah, the inventory and the car prices went up. I mean, they say used cars now. Someone was telling me that a used car in 2001, I think it was a Lexus, is going for a higher price than when it was brand new in 2001.
Wow.
So they're really going after used cars right now. The market is crazy. And of course, new car is, sometimes
astronomical price.
Yeah, and they're stacking on 10,000 or whatever the case is just because of lack of supply and demand.
I heard that. Yeah. So going into the bank, into the home industry, real estate industry, and doing home loans, did you have to change much or just a different verbiage?
It was quite different. Learning, all the parameters, loan programs, where when you're doing contracts, it's not as detail oriented. You're kind of prepping them for the finance people. So learning the loan programs, taking applications. I always tell the funny story. When I first started, they, hit the ground running, and a gentleman called me. It was probably $350,000 house. I picked up the phone at the Upland Countrywide, and the guy asked me, ballpark, closing costs. I think it was my second day on the job, still learning everything on $350,000. And I was sitting there scrambling. I think I told him, I don't know, $29,000. And I could just hear the guy, what? And he was just shocked. And I think the last thing I heard was the dial tone. So screwed that one up. But that was a fast way to learn. And I think a few of them that were trained me just laughing. And of course, we don't want to do that to customers, but they knew, hey, just answering the phone and, it's going to be a shock.
Yeah, I think it's in any job when you get out there, it's so different than the paper, right?
Yes.
I even say that with like real estate. Whatever I studied in the real estate test, real life is so different and so much more challenging. And you come across so many different situations. I kind of had the same thing, the first time I was working for a company and they had what's called desk time. And so I get hired. I want to say it's the second day too. And they're like, you have desk time tomorrow. And I was like, what the heck's desk time? And they said, you need to be here from this time to this time. You need to answer the phones. And at that time, it was the phones. It had all the buttons. And I was like, well, which one's what? And how do you put it on hold? And how do you pick it up? And they said, somebody's calling. And I was in front of a computer, and then they wanted to know about a property. And they're like, so I had one agent here trying to show me how to use the phones, had one agent here trying to show me how to bring up the MLS, and I have the client on the phone. All of this is going on, and it was a rental. And fortunately, I was able to meet them. I ended up selling them a house later on. So thank goodness we salvaged it. But I'll never forget having the two agents on my back, like helping me get through the first phone call. Yeah, a lot going on. Okay, so you've been in this business for 21 years. And you're no longer with B of A. What is the name of the company? And tell me, because it's actually a direct lender, correct? No, it's not a direct lender.
We're a broker. Came from the direct lending with Countrywide, was at Academy Mortgage for about a year. Countrywide transitioned, of course, to B of A. Been brokering now. The previous employer I was at, but I'd say about 10 years.
What's the difference between a broker and a direct lender?
I always say brokers, we have more choices. I think when we're programmed, we were at the bank, that was like brokers versus direct lenders. And of course, when you're at the bank, you're a mortgage lender or mortgage banker, and we're better. But I think once I got outside and I started to see the flexibility, the loan programs were not one-dimensional. And I always use football. It's like running a play and running the same offense, or running the same play every time, versus you can open up the playbook when you're a broker and you have multiple options.
I love that analogy. That's a great analogy.
Or I used to say 31 flavors. We're like, we're not just vanilla. We have 31 flavors. Yeah. I think we have 31 lenders we're approved with. So you got to have options out there, because not everybody's vanilla. You have one lender that could be, easy to work with. The guidelines are not as strict. They call them overlays, which could hurt you. So brokers, definitely the flexibility is there.
I really like that. I know that you have saved a lot of my clients in situations. In fact, one of the agents that now works on my team, we met him because he was a buyer's agent. I was representing the seller.
Correct.
And remember, his buyer the lender could not handle her loan. And I said, wait a minute, you got to try Mike first. And I say this all the time. When a buyer comes to me and says, we can't get a loan after all, we're going to have to pull out because we can't get our loan, I always tell them, we just had one just recently together, right?
Yeah.
And actually,
unfortunately,
with the same agent.
Yes, with him as well.
But he was on the listing side this time, and we were trying to save that buyer of that one. And your company has come and saved the deal on so many occasions, because you have this variety of things to offer the clients, which I really, really appreciate.
Yeah, thank you.
Yeah. So tell me, what are some of the things that you've seen over the years as far as interest rate? Because I know that's the big topic right now, that people are really worried about the interest rate and what it is right now. As of this morning, do you know what the interest rate was?
Check. I'm looking at my phone. Looks like they've gone down a little bit. Conventional is probably running in the 6.6. Of course, that all, varies on FICO score. Obviously, the higher the FICO, rate's going to be a little bit better. FHAs are running between 6 and 6.125.
Okay.
That on VA as well.
That on VA as well.
And being a broker, we always shop for the best deal. Not only great customer service, we want to handle, close on time, but my job is always to get the customer the best deal. And that's what I like, the broker side, because not all lenders have the same prices, unfortunately. Yeah. You'll see that variation.
What are I know I asked another question, I'm kind of jumping ship, but what are the criteria to decide what your interest rate's going to be? Because there's a range, right, that
Correct.
The client's going to fall under. So what are the things that are needed for them to get the best interest rate?
Well, conventional, there's usually 3 types: conventional, FHA, and VA.
Okay.
And then you got what they call the non-QM, which is, the outside the guidelines items, like when they have to go bank statement or stated, or there's all kinds of different things there. But usually it's the FICO score. On conventional is more sensitive compared to FHA and VA. So when you goes off your FICO score and your loan to value, basically how much down, that affects, obviously, the more down, higher FICO, you're going to get a little bit lower payment or a little bit lower interest rate compared to, say, 3% down on conventional.
Got it.
FHA is not as, they don't scrutinize as much. Usually on most lenders, a 660 for VA, on a FICO score for VA and FHA, could be the same as a 740. There's not as sensitive as conventional.
Got it. Is there a minimum FICO score that you need to get a conventional loan?
Usually it's 620.
620. And what's the minimum for FHA?
FHA, you try to get a 620. Some lenders a 620. I have lenders that can go down to maybe 550.
What about a VA?
VA theoretically does not have a minimum FICO, but most lenders need at least a 500.
Okay.
But you try to avoid, the 500 is going to be very difficult. There's reasons why it's a 500, maybe with a little bit more down on a 550. I've done a few. We always try to find ways to improve the score. Maybe small things we can do by maybe paying down some credit card bills to boost the score. So if we have some time, we try to see what we can do on what they call a rescore.
I really like that about you, is that I always tell clients, look, you're going to have a conversation with him. Even if he can't get you financed, he's going to tell you the plan to get you financed. Yeah. And I think that's like the number one thing we need as a consumer, is to have a plan, right? And sometimes we're so afraid to even try because we don't have the plan. So I love that you, even if you can't do it, you give them an idea of how they can make it work for near future.
Maybe just a fear, or they're just reluctant to have their credit ran. Because they think sometimes things are so old that it doesn't affect them, and they're pleasantly surprised. So, the other analogy, I love analogies, is it's like talking to a doctor and you're describing your symptoms. You have pain, but a doctor's not going to be able to diagnose you until you run tests, come in. My testing is running credit, looking over the credit report and seeing what is going on, why is the score the way it is, and maybe there's things we can do to boost it.
I love that. I think that is probably the number one fear, don't you think? That people don't want their credit ran.
Yes.
Yeah.
Or they think that their score is going to drop 30 points when there's 2 types. There's a hard pull and a soft. We can even do soft pulls now where it doesn't affect the score, but at least it gives an overview, maybe one bureau of where they're at. And then they know. Then they may want to move forward to the traditional, where they pull 3 bureaus. So
that's good. And
then you can really kind of dissect the report and kind of go over everything with them.
That's really good. What are the documentations that a person needs in order to apply for a loan?
Usually on my application, They'll fill out a one-page, very simple application with basic information. Then they'll need their W-2s for 2 years, a month's worth of pay stubs, and of course the bank statement or wherever they're going to, come in with the down payment. Sometimes it's a 401k, IRA, CD, savings, and if they're self-employed, then I need tax returns. I don't always need tax returns. Or if they have additional properties, rental properties, we need tax returns. So just depends. Everybody's a little different. Having the first conversation and finding out, what type of employer they work for or what type of work they do, then I can go into and ask for the proper documentation.
Is it harder to be a self-employed and get a home loan versus working for?
It has. I mean, they got rid of the traditional stated in the crash where they used to have reduced doc. They still have it, but it's more the non-QM for the self-employed, the bank statement
What's a
programs.
QM? Tell our audience what a QM is.
Qualified mortgage. Most loan programs that we do is a qualified mortgage. When there's non-qualified mortgage, that's kind of outside the criteria, outside the guidelines. And there's lenders out there, I hate to use the word hard money, but they're just not your traditional financing.
Right.
And they're out there. There's quite a few programs, especially for self-employed, because, we know they don't always show enough income, and there's different reasons why they are self-employed and they have to go that route.
Right.
So,
right. So even though you're self-employed, you still take a chance and buy a house, right?
They're still purchasing. A lot of times they have good money down, and the rates are a little bit higher, but it just depends on the FICO credit score as well. And there's some competitive non-qualified mortgage companies out there.
Yeah, definitely. Definitely. What is the difference between FHA and conventional? Because those are probably our top two. And then the other one is the VA, correct? VA. And we'll discuss that in a minute. But what is the difference between an FHA loan and a conventional loan?
FHA loans allow you to put 3.5% down. You can put more. I've had them where they put 5% down. To me, an FHA loan versus conventional is going to be easier to qualify for. Debt to income ratio is usually higher. Their guidelines are looser, if you will.
Higher in the benefit of them, or
yes,
higher? Okay.
Higher in the benefit of the customer. Debt to income ratios with FHA, you can go all the way to 56.99.
Wow.
As a total debt, there's two types. There's a front-end ratio, which is your house payment divided into your income, and then what they call a back ratio, which is all the debt combined or divided into your income. And FHA I've had them at 56.9 get approved.
Wow.
And you see more of the loan programs and more of the underwriting programs seem to be looser with FHA and a lot more liberal compared to conventional, or conventional usually is 50%.
Oh, okay. No,
so you can't see, and if you can get a 50, it's usually because of high FICOs, maybe good reserves. But when you put the two together, an FHA is going to have less fallout, I believe, and it's easier to work with everybody. I mean, seems like they're just more liberal, and you're going to have a better chance of closing.
I found we've had this conversation where sometimes sellers are more apprehensive in accepting a FHA loan or offer. They feel more confident with a conventional, but you just stated that
that's the misconception out there, unfortunately.
And what do you think that derives from?
Back when they had, that's what I'm dating myself, going back to the FHA non-allowables that they had similar to VA, where you couldn't charge these certain fees, but those have been, they probably went away 13, 14 years ago. Mm-hmm. I think the only difference, the major difference would be on an appraisal where FHA has to be FHA approved. They're going to flush the toilets, turn on the water, where on a conventional appraisal, it's usually just an overview.
Surface.
They're looking for health and safety issues that they can see with the eye. But to me, if you don't turn on your water or flush your toilets, and something's wrong, you're going to want that fixed anyways. You're going to find that out on the home inspection. So
I actually, when I do so for agents, we have to do what's called an AVID, agent visual inspection. And so when the inspector's there, I'll go in as well and I'll flush the toilets. Like you said, I'll open the windows, do the blinds, whatever I can do, look where I can look, because that's my visual inspection too. I mean, the hope is that your buyer gets an inspection and sees that. But as an agent, you want to try and be proactive as well for your clients. So
Yeah, definitely.
yeah, I tell them that too. Flush the toilet, see if it's making any gurgling noises,
Yes.
So we know. But okay, good. So let's talk VA loans. I think that those are coming a long way. And the same thing, I told you that I had a client that wrote an enormous amount of offers because no one, not that she wasn't qualified, but no one wanted to accept a VA loan.
Yeah.
Fortunately, it's kind of changed. She bought a house, she sold a house, bought another house since then. But I often find that sometimes sellers are apprehensive of taking a VA loan. So let's talk a little bit about a VA loan. I've also seen clients who were VAs who were apprehensive of using their VA loan and preferred to use a conventional with the same mentality that it would be really hard to get accepted. So what's the difference between a VA loan and all the other loans?
Well, VA loans is what I always say is down payment assistance. There's zero down.
But a VA can put in their own down payment, correct?
True. And I've kind of done the math for a lot of customers that look at 5% down, 10% down. And when they start doing the math, sometimes they figure just save the money because there's very little difference in payment. Some of them have funding fees. What a funding fee is a percentage of the loan that's added. It's financed into the loan. Now, it depends on what the certificate eligibility states, whether or not they'll have one. If they're usually 10% disabled or more, they waive that.
I think that's really important to bring up because I think what I found is a lot of VAs, when we went to go purchase a house, they didn't know about that cost. And that's actually charged to them by the VA, correct?
Correct. And it's financed.
Yeah. I did have one where they gave them the option to pay it all up front or throw it on the back end, right? So they do have that option to pay that out, right?
Yes.
And what's the percentage of that again?
It depends. For first-time users, is 2.3. I believe for it's 3.60 for returning or for cash out refinances.
Got it.
But the first time use is 2.3% of the loan amount. So usually the loan amount and sales price is going to be the same.
So instead of getting charged a down payment, they're actually getting charged that fee.
But there's no mortgage insurance. That's the beauty.
I love that. Okay.
You can go 100% financing, no mortgage insurance versus FHA is going to have mortgage insurance for the life of the loan. Conventional, anything more than or anything less than 20% down will have mortgage insurance.
I think also, isn't it very important, not all lenders automatically remove the mortgage insurance if you're doing conventional.
Correct.
So it's really important that the client, if they have a conventional, they have PMI, that they make sure they have a conversation when that reaches 20% to have it removed, correct?
Yeah, or they can call the lender. Usually, I've been told they don't want to even entertain it for about 2 years. And then they call them if there's comps in the area. They have to call their lender and determine how they're going to get that removed. Would it be appraisal or maybe there's an automated system that can give value?
So tell our consumer, what is a PMI?
Private mortgage insurance.
And what exactly is that?
It's insurance that if you default on the loan, that the investor recuperates the loss.
Yeah.
Correct. Same with FHA is MIP. It's one of the same. It's mortgage insurance premium. So, but they're basically the same thing. Now, the other thing that came about last week was FHA lowered their mortgage insurance by 30 basis points. We used to have,
that was huge.
Yeah, we used to have it was a 0.85. Now it's down to 0.55 for loan amounts 726, 200 or less.
So on an idea, kind of a little bit more in layman's terms, give me an example of a purchase where someone used the PMI in the previous one and now what they're going to pay on the PMI. Do you have something of that nature?
Yeah, I think I did a $500,000 sales price. The PMI affected the payment by about $120 a month.
Wow. The lower of the PMI?
The new one. And you can take advantage. It's not until March 20th, but my lenders, they are hit the ground running as of 2/28, which is a few days ago.
I love it.
So they can get the new PMI or MIP right away.
So if you're closing
effective immediately.
You're closing before, what did you say?
March 20th.
So if you close before March 20th, you'll be able to get that.
Well, that's when it goes into effect.
Right.
But there's lenders now that allows you to lock the loan with the new MIP amount.
Nice.
And I believe it has to close. I mean, we're already, usually 30 days.
Yeah, 30 days. It'll pass.
Yeah. So they're able to take advantage of the new MIP. Those changes.
That's really huge because I've seen where people are paying $400 extra on their mortgage payment on PMI. So,
Oh, easy.
yeah.
And the
easy.
last time they reduced it was 2015.
Wow.
So it hasn't changed in quite a bit. And that's what's making, I think FHA is going to be that loan that is going to be more popular. When you compare to, conventional guidelines are changing so much. It seems like they're getting a little bit, stricter when it comes to the guidelines, a little harder, especially for lower FICOs. So I think this is going to help FHA. Now, FHA has their, depending on the area, their loan amounts are going to be a little bit less than conventional. But for the most part, I mean, FHA is going to be, I think, the future. You're going to start to see that.
I think, so when I started off FHA, the PMI was only, it was until you reached the paid off 20%.
Correct.
Then it changed to, they were going to keep it on for a maximum of 13 years. So almost half the life of the loan. And then now it's the life of the loan.
Yeah, in 13, they changed it to the life of the loan. So the way you get out of the PMI is you refinance into a conventional loan.
Yeah.
So
it's, I know that a lot of people were apprehensive, even still when they're getting that, they don't want to refinance, but that would save them so much money on their payment if they have the opportunity. Yeah,
also the benefit of VA and FHA usually run about 0.5% in interest rate lower than conventional.
Yeah.
So that's also the,
benefit.
Especially with VA, the benefit, the VA versus FHA, you don't have mortgage insurance. And then if you compare the people that maybe are reluctant to try to look into their guideline or look into their availability with VA, they could get a lower interest rate by 0.5%.
Yeah, that's
and not have a down payment.
That is so significant. Yeah.
So
now, if a VA, let's say that they sold a house and they want to use some of that net to buy their next house and then also use their VA loan, even though they're putting, let's say, $100,000 down, they could still use their VA loan, correct? Yeah.
And if they have a funding fee, the funding fee is affected. It's lower with more down.
With more down.
5% down is a little bit lower. 10% down is a little bit lower as well.
Yeah.
So it just depends.
That's really good to know. Okay, speaking of FHA, one of the things that we run across as well is condos. So with a condo, it has to be called FHA approved.
Correct.
Or, warranted, right?
Correct.
Yes. So what is the difference of those? Because I think what happens is, and this is a normal situation where if I were a consumer and I saw a condo that I could afford, I'd want to go see it. But then I hear, oh, it's not FHA approved and I'm using an FHA loan. So what does that mean to a consumer?
Well, you're looking to make sure that it's either FHA approved, VA, or conventional. And with conventional, they call it is it warrantable? If it's non-warrantable, that means Fannie and Freddie are the two big investors with conventional. You're not able to get financing on it. Traditionally, you'd have to go to a lender that does the non-warrantable condos. FHA has their guidelines as well that you look up through the HUD website. Same with the VA. And you look up that complex to see if it's FHA or VA approved. There are times you can do what they call a spot approval. You will go in and get an HOA questionnaire, and there's a list of questions and has to meet certain criteria in order for the lender to approve it for that specific transaction.
So how does a client know if they could get a spot approval? Should they even bother to write an offer? Or is this something that they could find out prior to writing the offer?
If you can get the information from the listing agent, find out the HOA company, try to ask the basic questions, occupancy factors. If one entity owns more than 10%, soon you could kind of go through the list and you may be able to kind of get a heads up and see if it answers. If it's 2 out of 10, you may have a chance where the rest of them are going to meet the guidelines. I've had a lender tell me about a 50-50 chance because he does them. Okay. And there's more lenders that do them. It's just unfortunately for the buyer, someone's got to pay for it. The HOA companies are not going to fill it out. It's probably about $200. So
that's actually not that bad.
Yeah, if the buyer takes a chance, maybe there's some information that they found out that it may benefit them. They're willing to do that, and you can do the spot approval.
So it would be really good if they do find a condo that they like to have their agent submit that address to their lender, correct?
Correct.
and then
And
hopefully
it actually
find out
helps the
prior.
complex,
Yeah.
especially for an
Future.
agent that
Yeah.
they can maybe market the area now that, hey, I can get
Yes.
FHA approved loans on this complex.
Right. That's so awesome. Yeah. So also there's different guidelines for investors, correct?
Correct.
And what I mean by an investor is not necessarily somebody who's coming to flip. I'm talking about someone who wants to buy a condo and then rent it out, or wants to buy a house and rent it out. So what are the differences between a primary resident and primary residency and a house that you want to have as an investment?
Yeah, owner occupied is there's owner occupied, there's second home, and there's investment. Owner occupied, FHA loans are always owner occupied when you purchase. Same with VA, it has to be owner occupied. Where conventional, you can either owner occupied or you can buy with a certain amount down as investment. Usually, the minimum is 15% down, although a lot of lenders are 20% down on those. The rates are a little bit higher as well on investment, more risk, but you're also able to use some of the rental income to offset some of that mortgage to qualify. Usually it's 75% of the potential rent to offset the mortgage payment.
Got it. Speaking of, so going back to the VA, if I am a VA and my primary residency is used, I used my VA loan, but I want to keep it and then I want to go buy another one. Am I able to use my VA loan on the next house that I'm going to buy?
They call that
living in?
entitlement. It's used up. There's a calculation that I would put in there. Usually, your entitlement can come in when you're trying to move. Say you're in Missouri, now you're coming to California. You can rent out your VA home or VA loan and buy VA out here, and you'll get a certain amount that may be zero down. Worst case, you may have to put 5% down, but there's a calculation that once we get the certificate of eligibility, that gives us what entitlement was used up and how much they have to put down.
Okay.
So
awesome.
Something we can go into more detail once we have we call it COE, certificate of eligibility.
Yeah.
But it's been done.
I love that. I mean, there's so many opportunities out there for our VAs, and it's just a matter of having the right knowledge to go in and buy their house and buy multiple houses as well. So I love that program is out there. Okay. So what would you say? Well, actually, I want to kind of get into today's market, but before we do, let's take a quick break and get a word from our sponsor, and then we'll come back and we'll talk about today's market. Are you looking to refinance or purchase a home? If so, I highly recommend Mike Rolston with U.S. Lending Network. He has over 20 years of experience in the mortgage lending industry. He's a local mortgage broker and works with over 32 lenders to get you the lowest rate as well as the best loan program that fits your needs. Specializing in conventional, FHA, VA, HELOC, second mortgages, and down payment assistance programs. Don't be discouraged to start the pre-approval process because of your credit history. Mike at U.S. Lending has many lenders who can assist every borrower's situation. He has helped many of my clients with their financial needs and in various situations when buying a home. Don't hesitate to call or email him to start the process and get the best deal. His contact number is 951-318-8221, or you can email him at mike@uslendnet.com. That's Mike at uslendnet.com. Now back to the show. All right, welcome back. We're here again with Mike Rolston from U.S. Lending, and we're going to kind of talk about today's market. Although by the time this airs, I want to say a month might have passed by, so there might be change. Hopefully it's for the better. But we're just kind of talking about what's happening right now in March of 2023. Okay, yes. So before a person even gets into escrow or gets a loan, what are some do's and don'ts for them not to do?
Yeah, I actually have that written in a document. I think it's the 10 Commandments. Obviously, you want to try to reduce any of your income. In your credit card balances. Are you talking about in escrow or right before?
Let's talk about before escrow.
Before escrow,
I'm sorry to cut you off, but I heard that it's best to have your credit card debt less than, so for example, let's say your availability is $1,000. So never have it over 50%.
Actually, that's That's good. I was told, and I've seen when we do the credit modifiers, usually 20%.
Oh, wow.
So
okay.
once you hit 20%, it actually boosts the scores even more. So on $1,000, if you can keep, $200 or less on a outstanding balance, try to keep it there to maximize your overall FICO score. And once you pay it down, I think the other misconception is I hear clients will call me and say, well, I just paid it off. And then 2 days later, they think because they paid it off and maybe one billing cycle, they charge again.
Right.
But most creditors report at the end of the month. So if they report another balance, they wonder why their scores are not moving up because they've used it again. So I try to tell them, pay it down, put them away.
Well, sometimes I think people also forget that just because I paid it off right now, there might be a residual interest charge. And so you might have a little bit next month. So always double check your credit card.
Or it could take some time.
Yeah.
If you pay it off like now or the beginning of March, it may not report until March 31st. So now when you run credit, you may have to wait until you're in April for the bureaus to catch up and report the balances.
Now, does it ding your credit if you cancel your credit card or you close your credit card?
They always say if you have say you had a credit card for 10 years and it's in good standing, you never want to close it. You want to pay it down, leave it open, because that's good credit that you're going to want to build off. So, and usually late payments, some people come back, like you say, they're reluctant to run their credit. 4 years ago, I had a collection. Well, as time goes, like anything else, time heals like a wound. It'll be less significant on their credit report, especially late payments, maybe 4 years ago. Eventually they fall off, but something that's 4 years old is going to have less effect than something that is, or, say 6 months. So
what about like a bankruptcy or something of that nature?
Bankruptcy, we can still get them approved. FHA is usually 2 years out.
Okay.
There are 1 year with special circumstances. Maybe the death of a spouse can be a reason why you're allowed to get an FHA loan within a year. Job loss. I mean, you got to prove all this. But usually it's 2 years on FHA, 4 years on conventional.
Got it. Got it. Okay. All right. So I know I had asked, what are some of the do's and don'ts before you get into escrow?
Yes, try to pay down what you can. Obviously, if you know you have collections, maybe I would always go to a lender, have your credit ran, because there's times that people will pay off their collections, and sometimes they report it as a new fresh collection because now it's a zero balance. So you always want to maybe have your credit ran, even if it's a soft pull, so you can see what's on there, because it may not benefit you to pay off the collection, especially if it's older. So you don't want to do anything on your own, which is always great to pay off everything, get it current, especially collections, but it could actually hurt your scores.
Oh, wow.
So, getting the diagnosis first before you do that is always going to be beneficial.
That's good to
know. Keeping your credit current, paying your bills, paying off those credit cards as much as you can will definitely help.
Okay. What about buying a vehicle?
You want to avoid that unless obviously you need it. I had a client, I always say talk to your lender. Had a client, needed a car in middle of escrow. Obviously, if they need it, what do you do?
Right.
But as long as they let me know it's probably going to come up, because a lot of lenders will run another inquiry sometimes in the middle of escrow, sometimes even at the end. If they see Ford ran their credit and maybe they purchase a car, they want to know what that is because they have to count that debt against them.
Okay, so that would be during escrow. But so before escrow, does it matter? Let's say that I go and I buy a vehicle, and then I go tomorrow and I try to apply for a mortgage loan. How can that affect me? That just changes my debt to income ratio?
Well, they see it as an inquiry. They want us to address inquiries. If there's any new inquiries, and they will investigate. If they see Ford on there, they're going to wonder, okay, because sometimes it takes 3 weeks for the inquiry to actually show up as a debt.
Okay.
So they will find out. So you want to be forthcoming, let them know, or, hey, if you did buy a car, nothing you can do now if it was 2 days ago, but you try to, if you can avoid any major purchases until we close. And I say that until you close, because you don't try to avoid doing any of that in the middle of escrow or even before escrow, because it can affect your sales price, what you qualify for, and your interest rate even. If Depends on the debt. So
what are the things to not do during escrow?
During escrow, obviously, no major purchases. Keep everything current. Don't try not to co-sign for anybody. Yeah, because they do that too.
I think that's a big misconception. I co-sign for them. I'm not really the person who's responsible for this item that I co-sign, the car or whatever that you co-sign for, right? But that counts against you too because your name is on that item.
Now, unless it's 12 months old and the person that is making that payment makes that out of their account, we don't count it against them. But they have to prove that. They have to have 12 months, either bank statements or canceled checks to show that they've been making the payment.
That's really good to know. We actually had a client, I think, like that too. He co-signed for his daughter, and it wasn't a 12-month period time yet.
Yeah, there's some lenders, if it's 11 months, 10 months, they may make an exception. And the other thing is don't give your parents cash. Say, well, I make the payment, give them cash, and they make the payment. You want it to come out of their account.
Yeah.
So if it's the child and the parent, make sure the child, out of Wells Fargo, it's coming out. So you have those. So you kind of keep the parent away. Same with the house. You can even co-sign for a house as long as the other person's making the payment. We don't count that payment against them.
I love that. I think, but that's really important too because it helps build that person's credit because if they're showing that they're making the payments out of their own account, it's a benefit for them.
Yeah, and you want to keep it consecutive.
Yeah.
You don't want to have 6 and then pay cash and then 6 again. That can throw it off.
Yeah.
I've seen that where they decided, I'll just give my parents cash. I don't want to make the payment, but that throws it off. Now you got to count that against them because it's not 12 in a row.
I've seen a situation where the person was a renter and they had to show proof that they were paying rent for the last XYZ amount of time. And they were paying cash the whole time, or they were, I want to say, Venmoing the landlord. So how can that affect them?
Yeah, with certain programs, conventional is probably going to be a little bit more, a little tougher than FHA to prove that. They call that a verification of rent. A lot of times we don't need it. Very few times does the underwriter even need a verification of rent. Although a lot of times it's the underwriting program, which is called DU, desktop underwriting, and there's also Loan Prospector, which is LP. Those are the two types of underwriting programs for conventional. They're kind of the Bible when it comes to that conventional loan, and sometimes they want the verification of rent. It could be because of payment shock. These underwriting programs, when they come in, underwriters follow that to a T. And if they need it, they need it. And now it's a matter of how do they pay? Sometimes you can get a landlord to fill out the verification of rent. A lot of times they may want to see proof on a bank statement. And if they're paying cash, Venmo sometimes will have statements now, and they're getting better with that. Because I've seen it on mine.
History.
Yeah, I had a gentleman that was a barber that had to show proof that he's still in business, and he was able to show Venmo getting paid rather than into his, because he didn't have a business bank account. So there are cases that you can, utilize Venmo and some of these other, payments.
Apps. Yeah,
apps.
So what would you recommend to somebody who is a renter? What would you recommend for them? How for them to pay their...
Try to pay by check.
Yeah, not that many people.
Or something that can show maybe an ACH or something that can show to, even if a property manager, because I know there's property management companies now, you can go online, you can pay electronically.
Pay online, right.
Because I know checks are becoming a thing of the past. We're dating ourselves.
I don't even know that our young generation knows how to write a check.
Yes.
Yeah. Where with us, I think it was taught in 3rd grade.
Correct.
So funny. Were you taught how to write a check, Joaquin? Yeah.
Not that bad.
I'm asking Joaquin, who's doing our photography over here, if he knew how. He's a youngster in my eyes. Okay, so definitely make sure that you have a paper trail of everything that you do, correct?
Correct.
Yeah.
That definitely helps. But just keeping things, the major purchases, you get customers that are excited. They're on week 3. They're at Jerome's or living spaces. They want to, don't do anything until we know we close. Then you can go buy and get your, furniture or whatever, TVs.
I had one client, and I always kind of share her story with my other clients because it could totally change the dynamics of the loan, right? So she did exactly like you said, super excited to be buying a house. She was buying a bigger house, went to, Marshall's, went to Living Spaces, went to all these places and spent about $9,000 on furniture. And, like you said, they don't just run your credit in the beginning. Sometimes they run your credit at the very end, correct?
Correct. They're looking for inquiries.
Right.
And then they'll investigate. And sometimes it will not hurt you. If your debt to income ratio is low enough, maybe it's not going to put you over that, maximum. But there are times if it's really tight, you did something like that, now what? Now we got to scramble when we're trying to figure out what to do.
So do you try to advise your buyers, okay, we're going to do your loan. This is what you have. Now, if you're going to spend, do not spend more than XYZ
Correct.
dollars.
Or let's tell them to call me. If
Yeah.
they're going to do anything, changing jobs is another misconception out there. That you have to have a 2-year history, which is not true. On the job, you need a 2-year history. You can go back. Even back years ago, could be stay-at-home moms that got back into the workforce. Usually once you're back at 6 months, you can use that income. You don't have to be on that specific job for 2 years. But I had a client who was going to get a major advancement, and it's like, how can I tell her no?
Right.
When she's going to go maybe $25,000, $30,000 a year. So I said, as long as we can document we're early enough in escrow, then you can change jobs.
Nice.
As long as it's full-time. You never want to go full-time to part-time because then that changes everything. But, you try to avoid it, but there's sometimes you can, and we can make that change in the middle of escrow.
Do you recommend that they stay in the same field, or does it matter? So, for example, if they were a teacher and then they decided to, go be a culinary chef. I don't know.
As long as it's not going from, say, a chef at a restaurant and then self-employed. Although now the guidelines are changing. It's the same field. You may only need 1 year of self-employment versus 2, because normally you need 2 years of self-employment, 2 years bank statements. 2 years tax returns. But yeah, the other misconception that you have to be in the same line of work. No, I've had people graduate from college and then get that offer letter, get a salary job. We can use it right away. The college is your 2-year history. You get transcripts. I'm glad that you said that, because I always thought they had to stay in the same field. It didn't matter if they went from job to job. Yeah, we get that a lot.
Yeah, or they
have to be on the job 2 years. Well, no, if you had different jobs, you've been on a job a year, it's much easier with salary versus hourly. Now, most of the programs on overtime and bonus, it's a 2-year average. They want 2 years on the job. Depends on the loan program. FHA, a little bit more liberal. They'll allow it 1 year average on overtime. But for most part, it's usually a 2-year average for all of them.
I had one of the agents on my team, his buyer lost his job. They just laid him off. And so he thought about canceling escrow. And I was like, don't cancel escrow if you know you're getting another job.
Correct.
And he was able to get another job within the week. And so had we not had that conversation, if that agent didn't call me and say, oh my God, this is what's happening in my escrow, and we didn't have that conversation, they would have lost the house that they wanted. And so fortunately, they were able to get another job right away and stayed in escrow and closed out.
Yeah, you just do a verification of employment, and underwriter can just update the application and move forward from there.
What about quitting your job?
Yeah, you never want to quit your job.
Or go to retirement. Yeah.
Yes. Yeah. If you're going to do all that, wait until you close.
To actually close.
Correct. Because they do verification of employments right before, a lot of lenders, right before loan docs are going out.
Yeah.
So that sometimes it takes a day trying to get a hold of someone there. But yeah, you never want to hear our worst nightmare is, oh, sorry, they no longer work here.
Yeah.
And you're like,
they
is
quit
2
yesterday.
days before we close. Yes.
Yeah. They quit yesterday. They're
so
like, but we thought it was good to go.
That's another do and don't.
Yeah.
Don't do that.
What are some of the craziest things that you have seen in this industry that you like I said, when I'm talking about the person who spent $9,000, we did have to go back and recalculate all her stuff. And he told her, okay, you can't spend more than one more, like 10,000. I think he was giving her one more $1,000. Like, fortunately, you're in the window. Don't do that. She still ended up spending the more that she was supposed to. Yeah, like he gave her cap and she thought, oh, maybe he gave me a cushion, And it's like, no, you really need to adhere to that number. So, and I always share that story because I think it's so important that we get excited. I mean, and we want to go out there and we want to start buying furniture and we want to do this and we want to do that for the house, or we want to go out and we want to buy a car. Okay, I just got the house. Now I want the car to park in the driveway, or I need it, right? So those are huge purchase items that we definitely want to talk about. What are some situations where you have found or experienced where it fell out of escrow because of a situation?
I would say a new car purchase.
New car seems to be the top one.
Yeah. Not so much the furniture. I think we warned them, and being in the business 21 years, seems like I'm reiterating what not to do, just so they're prepared. But any major purchase, especially the car. Now, I had one that needed a car or maybe they're replacing a payment. So then they told me my payment of $500 is going to go maybe to $600. And then I start calculating on the debt to income ratio, will it affect them? And knowing that it's not going to be that much of a difference, then we're fine.
Okay.
But I would say car purchases are probably the worst that could cause something to fall out of escrow. Going back to the overtime and bonus, say you're using that and it's been, many, many years. A lot of law enforcement has a lot of overtime, nurses. Yeah. And
Fire
if they write on there
nurses,
on a verification of employment, and they usually check a box and they don't check that box that is likely to continue, that can hurt someone's overtime. You may not be able to use the overtime or the bonus. So someone filling out that VOE can make or break a file as well.
Wow.
So finding out, hey, I'm using overtime. Do you foresee any changes? They may say, oh, yeah, we're no longer getting overtime as of yesterday. You're like, thank God you asked that question, because maybe they made 30, 40,000 overtime. We're using that to qualify. So
that's really good.
Or they decide not to work overtime. So underwriters want to see, obviously, if you're using all that overtime and now they're in the last 2 checks while you're in escrow, there's no overtime. Something, it makes the underwriter very nervous.
That's understandable.
Just getting with them and kind of get an overview on what their situation is with income.
Really quick, going back to condos, we talked about like overtime, but one of the other expenses that we didn't talk about is HOA fees,
Correct.
Right? That can
Homeowners
affect them.
Association.
That can affect them
we
too.
take that in consideration as part of the total payment. So some HOAs are $350, some are $450, some are very expensive.
Depending on,
You can go to the desert, Palm Springs. I think I saw some of them were like $1,000 a month.
Isn't that amazing?
Yeah.
That's
For what
an
you
HOA.
get.
Exactly, for what you get.
Maybe you get massages for throughout the week. I don't know. Something's free.
Something's free.
For that kind of money. A free round of golf.
Yeah. I've seen $650. Yeah, it's amazing when you go by the beach. The HOA condos are much higher.
Yes.
Definitely.
Especially the amenities and what's there.
But
that can, you're right. If I'm calculating $350 a month and I find that's $1,000, that changes everything, the whole qualification.
Not only the HOA, but also the tax on the property, correct?
Correct.
So if we go to a new build and we have a 2%, which seems to be the average on a new build, 2%.
Yeah, for the Melloroos, or what they call special assessment taxes. Their property taxes theoretically are going to be more on new build because someone's passed along that expense to the bond holders, which would be the people that are living there, homeowners.
Yeah.
And usually they pay, that's how they get the hardscape, the community, that's how they build it. They pass it along to the taxpayer. Now,
does a lender, do you need to be a special lender in order to do a manufactured home or to do land?
Those are specific lenders. I have lenders that do manufacturers.
Oh, okay.
We have one lender now that's doing construction loans.
Oh, okay.
Some are doing land. We have a few that are kind of the outside of the actual guidelines, but those are kind of specialty programs. But manufacturer is pretty well known, but they have to meet certain criteria as well. I know it has to be built after June of 76.
Oh, wow.
That's huge. because we've had them before where they've been built, maybe the listing agent says it's 77, we find out it's 75,
Yeah.
and that changes everything. You can't get tradition. It has to be HUD approved, and they call it HUD tags. Has to be on the coach itself, and then there's guidelines. The wheels removed on a permanent foundation. So you just have to do some research and make sure that you have financing on that. Otherwise, it's different financing, similar to like an RV, and the rates are going to be much higher.
I've definitely seen that. Where
usually in parks, you'll see that they don't own the land. You're paying what they call space rent.
Yeah, land lease. Yeah,
correct.
Yeah, I've seen some really pricey land leases,
especially by the beach.
Yeah,
you see $1,000.
Oh my gosh!
Think Leisure World or something.
It's like outrage. I mean, for me, I'm like, wow, that's crazy. But hey, there's something out there for everybody, right?
True.
Yeah. So speaking of programs, what are some of the programs that you're seeing right now?
As far as what financing?
Yeah, as far as financing, new homeowners, first-time homeowners.
Yeah, I think first-time home buyers are more attractive now to down payment assistance. It's kind of come back.
Before we talk about that, what qualifies you to be considered?
You have to not own a property within the last 3 years.
Not own a property?
Correct.
So even if
so if you own a rental property, you're not a first-time home buyer.
Oh,
believe it or not.
Wow.
Now you can still get an FHA loan if you own a property. That's another misconception, that FHA loans are only for a person that has not owned a property in the last 3 years, but that's more of a down payment assistance where they have those guidelines. But not every down payment assistance has those guidelines as well. You just have to investigate what type of program it is.
So just to clarify, so if I own my house right now and I've owned it for 15 years and then I go out to buy another house, I'm not considered a first-time home buyer. I would have had to own my house, sold it, rented for 3 years,
or live with someone,
and then I could qualify for
correct
first-time home buyers. That's good to know.
Correct.
Okay, so what are some? You mentioned down payment assistance. What are some programs, and how can they help our buyers at this time?
I say the big one right now is through the state of California. CalHFA allows them to get a down payment of 3.5% down. They also do conventional. That's on the FHA. I think the most popular is FHA, 3.5% down. And in our county, Riverside and San Bernardino County, they can make up to $173,000, which is a lot.
Yeah.
Because a lot of these down payment assistance programs have income limits. A lot of red tape to them. Some are better than others. I'm kind of a big fan. I'm kind of promoting CalHFA because of that, just because they got rid of, there was a time where it was based on family size, which made things crazy because they don't have that on their tax return and their cousins now living with them. And there was just so much red tape with that. Now they just basically give an amount, and $173,000 is good income to be able to qualify, especially out here.
Riverside
in Empire.
So CalHFA gives them the 3.5% down?
Correct. Into a silent second that they pay back.
So they do pay back.
They don't have to pay it back until they either refinance or sell the home.
Okay.
And there's no payment on it. So there's one program that gives them 3.5% down. They could get closing costs. Now the rate's a little bit higher if you take what they call the ZIP program, which allows them to get closing costs as well.
Wow, I really like that. So they can go to the lender and get the closing costs that way.
Correct.
Or
the down payment, or the sales price of whatever the sales price is, they help them with the closing costs. It depends on what they need. Closing costs are a little bit more expensive on down payment assistance, but it can come from, especially FHA, can come from the seller, up to 6%.
What are some of the criteria for them to qualify? Sorry.
That specific program needs a 640 minimum FICO. I believe it's 660 on conventional and manufactured. I know manufactured, they're going to want, and they actually do manufactured on that as well. They want a little bit higher of a FICO. But 640 is pretty low considering.
Yeah.
Because there's some down payment assistance out there that goes low as 600 FICO.
Wow.
Just not, there's tons of them. There's even through the county, there's programs, through the city have assistance. CalHFA is actually getting ready to roll out one that's 20%. Yeah,
What?
up to 20% down.
And is that going to be a silent second as well?
Correct, and it's equity share.
Oh,
So they're rolling out those guidelines at the end of this month. So we're excited for that. To give someone 20% down to really keep their payment down. Now what happens as far as what I can remember off the guidelines, because there's not a whole lot of guidelines left or on the program yet, but they'll probably share a program. Well, on that program, you'll share about 20%. So you get your 20% back, the lender, and then I believe it's 20% of the future equity down the road. And there's caps on that as well.
okay.
So I'll be able to give more information once they haven't officially rolled it out. So I don't have, all the details on it, but knowing that there's a small equity share, a lot of people are still excited because that's a lot of money to help pay for down payment or closing costs.
And then you're not paying the PMI on that, right? Because
Correct.
it's already covered.
Exactly.
So, and is that portion a higher interest rate, do you think, versus your regular loan?
Yeah, usually down payment assistance is going to be a little bit higher. The closing costs are a little bit higher as well. But down payment, the interest rate is going to be a little bit higher. It's not much. I mean, as of Friday, I think it was 6.25%.
Okay.
And normal right now with FHA and traditional FHA is around 6 to 6 1/8. So not too bad. That's
Not
the
too
other
bad.
thing I like about that. Their programs is their rates are attractive.
Yeah.
They're right there. At one point, a few weeks ago, it was down to 5.6.
Wow.
So
I think a lot of us were really spoiled by the 2s. I mean, that lasted like a blink of an eye,
yeah,
but it stayed in the 3s for quite some time.
correct.
Yeah. And so I think having that, seeing that. So are there any programs out there right now for people who do own a home and want to buy a second home? Because I think there is so much equity in the houses right now. People who if they bought up to a couple of years ago, then they have equity. If they bought a year ago, they're not really going to see that. But if they bought 2+ years ago, they're going to have a decent amount of equity to be able to either sell and use that to buy another one, or they have such great interest rates that they don't want to lose that opportunity, that they're keeping that house, renting it out, and going out and buying a different home. Because I think also during COVID, a lot of people, there wasn't that inventory. We had so many, 19+ offers on a property. And so a lot of people were getting into houses that may not have met all of their criteria. So now they want to go back out and they want to go shop. So if they're able to keep that house, I always recommend them to keep that house, especially if it's a low interest rate. And then
can rent it out.
Right, can rent it out and then go buy another one. So are there any programs out there right now for that buyer, for that consumer?
Well, on that specific person, if they can go as low as 5% down on a conventional loan. So they can buy it 5% down, take the potential rent on their current home and use 75% of that to offset their mortgage payment.
Very nice.
So they can get into it. FHA is a little different. FHA wants you to move about 100 miles away in order to utilize rental income on your current. They changed that guideline, let's say maybe 5-6 years ago.
So they still want you to move 100 miles away?
Because what was happening, a lot of people were buying
multiple houses.
Well,
in that
maybe
area?
they were buying FHA and there was really a rental property, but they were buying FHA owner occupied. So I think maybe FHA was, getting themselves into some trouble there. So then they made that guideline. If you're going to do an FHA loan at 3.5% down, in order to utilize the rental income for your current residence, they call that departing residence, they want you to move 100 miles away. If you don't, you can still qualify, but they're going to hit you for both payments.
Got it.
Going to count both payments against you.
So it would be best to do, if they had an FHA on the first one, do conventional on the second.
Correct.
If they qualify.
Correct.
Yeah. Yeah.
You just got to I'll do the calculation. There's some people that maybe do cash out refinances out of their current home to be able to purchase investment or a second home since they have so much equity. Some people are doing home equity line of credits, which are second mortgages. So, with all this equity, they're trying to use it up and utilize it to buy other properties.
Speaking of home equities, what are we looking at interest rate wise for the home equity loans?
Yeah, they've gone up quite a bit.
Yeah.
They're in the 9s now because of what's happened with the Fed increasing what they call the discount rate, which affects the prime rate, which is variable. And as anybody watched the news, those rates keep climbing, which means the home equity line of credit rates are not as attractive as they once were.
Yeah.
Which they were maybe 5 and now they're 9.
Yeah. Speaking of guidelines, there's FHA guidelines as far as how much you can use on an FHA loan, correct?
Correct.
So per county, what are we looking at?
County on Riverside, San Bernardino County has changed. I want to say it's 640. I should have checked my guidelines. And I know 23 just rolled them out. I know it was,
it
was like 562, but they've increased and they're in the 6s now for Riverside and San Bernardino County. VA conventional, everybody has increased their limits, which help a great deal, especially out here. Now you can get into, I think it's 726,200 is VA. I'll back up on that, is conventional. So anything 726,200 or less is considered traditional conforming balance.
Right.
Anything over that on conventional is what they call a jumbo.
Yeah, that's
now,
good.
FHA, I want to say I know it's in the 6s now when it was like in the 580s.
So if someone,
because it went to about 642, I believe.
So if someone let's just, okay, 642. So if someone wanted to buy a house, let's take San Bernardino County, let's take Chino Hills, for example. All right. So they have a house that's 650. Well, no, let's go leave it a little bit higher.
You do 650 because you take away the 3.5%.
Yeah.
So as long as then take away 3.5%, then that, as long as they're under the income limit, they can go FHA.
Right. So they can't buy a house at 750 because that's not going to be the 3%.
Theoretically, they could if they put more down. You got to just go to that loan amount and make sure it's that loan amount.
The loan
or
amount
less.
can't exceed that amount. It has to be below, and then the rest of their income has
Correct.
Yeah.
Now, VA doesn't have one, but they do follow pricing.
Right.
VA, I know there's lenders that go to $3 million, but anything over 726,200 is considered a high balance VA, or the VA jumbo. Pricing is a little bit higher, but you could still go buy a house for $1 million, 0 down.
Wow.
On VA.
That's pretty awesome. That's pretty awesome. Okay. Any advice that you have right now for today's consumer and buying a home?
I would say be patient. Their inventory, it's coming back. I know it's still limited. I think just because of the times we're in right now, making sure you get with your lender, maybe even prepping just to see where you stand, especially if you don't know if you have good credit. It helps to find out where you're at. Doing pre-approvals doesn't cost the consumer anything. I encourage them to do that. That way they know exactly where they're at. Sometimes they qualify for maybe $600,000. But maybe they want a payment that's close to the $500,000.
Yeah.
So they don't want to have payment shock where they get excited. It's like looking at that Mercedes, but then you want that Honda payment.
Yeah.
So you got to be careful. Make sure you go over your financials. And they always tell me what they want on a payment and what they have available for down payment. And then I communicate with you and make sure that you're showing them the right type of house. So they're not excited to see that Mercedes and, they want something more affordable.
On average, I think this is a really good question that I get all the time. It's like, all right, Christy, we qualify for 650, but and then we're going to maybe buy 630. But you know what? This house over here is 640. What's the difference? Isn't there like
it's very minimal.
Yeah. So
it used to be
on average,
we used to do $5 to $6 per thousand. That may have changed as rates go up. Depends on the property taxes, but on average, you can say for every 10,000, it's probably $65, $70 a month.
Yeah,
which isn't much
on
at all.
Not very much at all.
Yeah, not very much at all.
Yeah, I think that's like my weekly Starbucks.
Yeah, and I had a client back in the past that it was like a certain amount, $2,000, not one penny. And he was very serious about that. And then, of course, you see some of the bank statements, you see a lot of Starbucks, and I'm thinking, well, just one Starbucks in a month, you cut that and you're right there.
Make some of it at home
Exactly.
Yeah. I think I always tell clients, in the beginning, you're just going to try and tweak everything where you're spending. You're going to look at things differently because now you own the home. So you do want to at least try to put some of your income away. So just in case something happens. but like you might have to fix something or something breaks because now you're responsible for the maintenance of the house.
That's an investment.
Right? It's an investment.
It's going to definitely benefit them with the, the taxable, you'll be able to write that off on your taxes now.
Yeah.
The mortgage interest.
Yeah. But I love that. The best advice is to at least have the conversation. And even if now is not the time, you have the roadmap to get you to where you want to go.
Exactly. Yeah.
Right. I love it. Okay. So, kind of wrapping this up, this is one of the questions I always ask my guests. What would you tell your younger self, seeing how the market has gone from point A to point B when you started in this industry to now? What would you tell your younger self? And I know that we can't change the past. I mean,
you can come up with a time machine.
Yeah, for sure. But what would you tell yourself, 18, when you started? And then what advice, taking it to someone who's maybe in their 20s, what would you advise them?
To save, maybe not get caught up on a very nice car. Because I have a young client that I've had, he just was assistant manager at McDonald's and took a job, I think, at Wells Fargo as a personal, just moved his way up, became a branch manager, and bought with me, probably got three 2 units and a single family. And he's awesome. Under 30.
He's under 30. We actually
that's
have
exception, but that's awesome.
We actually have a client right now. He's 23. Him and his wife are 23 years old.
Wow.
They're selling their condo that they've owned for a couple of years and buying their second house at 23.
Wow.
That's so amazing.
Yeah, they're definitely, real estate in the long run is going to really benefit them. If they could save the money, be disciplined, you're going to build a portfolio. Yeah. It's another form of retirement income, passive income down the road.
Passive income.
If I can have gone back, especially the crash, I'm sure all of us go back to those prices of the crash. We scooped up 4 of them.
Yeah.
You can imagine in Orange County by the beach, you could have got something.
I had a condo in Laverne that sold for $90,000.
Oh my gosh.
And a couple of years later, that client turned around and sold it 2 years later, $250,000.
It's probably worth 5 now.
Probably worth 5 now. Yeah. So amazing. So your advice would have been scoop up, save, and then to the young person now, save. I think that's so important. I think we get caught up in the name brand of everything. But when you speak to or you hear millionaires speak or billionaires speak, they're not walking around to name brand clothes. They're not
very disciplined.
Right. If they have a fancy car, they also have the economy car, the car that's going to get them from point A to point B on a daily basis that doesn't have a name to it. Correct. Or I shouldn't say it doesn't have a high dollar name to it, because there are some great cars, Hondas, Acuras, they're all great cars, but they don't come with the high price tag.
True.
Right.
Yeah. Some of the others.
Yes.
Especially the foreign, German.
I know. Yeah, I have one of those too. So I completely understand. And everybody keeps saying, when are you going to trade it in? I'm like, nope, this baby's going to last me as long. To make another car payment is just kind of, I don't have to. I won't. Yeah. But I think that's what I would tell my younger self as well.
And it helps them qualify too, having less debt. If they can get in and maybe have that beater, that 1999 Honda Civic. Yeah. But then allows you to qualify for a house that's going to benefit you down the road, and you're going to get some equity.
Yeah. What do they say? Invest in the things that are going to give you a return on your investment.
Correct. And although used cars right now, believe it or not, do have some investment. That's very strange, but this won't last forever.
I think it's because it's the mentality of not wanting to buy the brand new car, not wanting to have to pay that price tag, but you're still getting a great car that's going to last you a couple more years. So I think that's why people are starting to pay more on the used cars. Yeah. Opposed to, and like you said before, inventory, right? That's Correct. What we have.
Supply and demand with everything.
And supply and demand is what changes the economy and the marketplace as far as real estate goes as well too. Correct?
That's very true.
Yeah. So where can we find you if we're trying to, maybe find that roadmap for ourselves to get to the next point of purchasing a home? Where can we find you?
I'm on social media. You can text me, call me. Availabilities.
So, social media, what is that both Instagram and Facebook?
I have both.
Okay. And what are your names?
That's a good question. I think I have.
You just posted the other day.
I know. You think I'd pay attention to that? I think I'm M Rolston on Instagram.
Okay.
And Facebook has been so long that I don't think I haven't checked my username in some time. But I tell most customers to call me at,
and what number can we reach you at?
The 951-318-8221.
And what about an email? Where can we reach you at?
Yeah, Mike@uslendnet.com. That's probably the easiest. I'm kind of old school there, but I've had instant messenger where customers will see something and, can DM me if they have to, with information. So.
Yeah. And if you need any kind of, review of past clients, I have a ton of clients that have used Mike. I've constantly used him. I had the fortune of meeting him a couple of years ago, 5 years ago, like I told you. And he's one of my top lenders out there. And he's gotten clients out of situations. I already know if I have a buyer that comes to me, whether I'm on the listing side or the buying side, and I know that they're going to have a situation that needs to be handled with nice handled gloves, I know Mike's going to take care of them. So if he could take care of them, he definitely could take care of you. Definitely. Thank you, Mike. I really, really, first of all, appreciate you. I think I tell you that all the time. I just love that I could go to you at any time and ask you questions. You're there for my clients. You're there for me. And I just appreciate you so much. I appreciate our business relationship and our friendship.
Likewise.
And thank you so much for being on with me today.
Thank you for having me.
All right, guys. Until next time.
Thank you, everybody.
Thank you for joining us on Coffee with Christie.